Well, good morning, ladies and gentlemen. As you can see, absolutely nothing has changed in the risk dial, minus 71. Allocation still not in risk, but risk off. And if we look at the scores, we'll see that basically throughout the week, even with the rally, they deteriorated, which basically means the internals of the spreads are still very much in a downtrend, and it means that actually the downtrend is intensifying. That's all that can be said, and really I get the feeling that this is going to last for weeks. What you should not expect is for this model, as you should know by now, to catch a low. This is not what it's intended to do. It's intended to forewarn, and it's intended to show you the state of the internals and not to catch a low in the market. If we look at the deviations, all the rally has done is get us out of the green and into the normal distribution. Very much still a downtrend in every single component of the S&P. There are none now which are in the green, and they've all moved into the white. But all that means is that we have a considerable way to fall back towards support. That's the best that can be said of this market. And that is why, as you saw, I tweeted that at 26.25 it was time to get out and reassess. I really do think that now this process is going to take some weeks to even calm down the market, and we will have several retests of these levels. I will show you later why I think that. But for the time being, we have to stick to our knitting when we have to look at the individual charts of all the asset classes and see how they come together. It is important to know what to look at in these times and what to not look at. Now, this is the chart that we do not look at anymore, because here we are, you can see how the expectations of the forward earnings are now plummeting. And this is normal because analysts take a long time to revise their forecasts, way behind the market. The market leads them by weeks, and we could have a situation like this. In fact, I expect to have a situation like this in terms of analysts' expectations catching up with reality, and this could go quite a bit lower. Therefore, this is a chart which we will not look at for the next few weeks because it's absolutely pointless. This is not a model. This is just telling you the reality of where we are. We are now going to go probably somewhere around times 11, times 12, but that doesn't mean that in reality we're not way above 20. Now, bonds, I always say, lie least. We are at a level in 2-year notes where the absolute level of the 2 years is going to tell us not a lot. I mean, we're at, what are we at, 25 basis points, so where's this going to go? Up? No. Every time it goes 10, 15 basis points higher, there will be buyers, and every time it goes down towards zero, there'll be sellers. The only thing that's going to give us any clue about what is going on with bonds is the shape of the yield curve, the 2s, 10s, 2s, 30s. Now, as I predicted last week, we backed off from the 75 level, but we're still above the 35 level and the 29 level. These areas here now are going to be the median levels, the I don't know what the hell is going on level. The 13, 14 mark to me is the absolute Rubicon. If we see it crash through there, then we are in a world of pain. that is what the yield curve is going to say. My preference is for a consolidation here between 35 and 75 for several weeks before we start breaking up again. As you know, please have a look at last week's video for the arguments, but to me, several weeks of consolidation now between 35 and 75. I will be a buyer at 35 and a seller of, if we get into the 60s and 70s. To me, this is now a trading market. If ever we fall below 14, we have a real problem on our hands, and that is all that the yield curve is going to tell us. It's absolutely pointless looking at the relative levels in, the absolute levels in 2s and 10s. They're going to tell you absolutely nothing. From now on, it's only the shape of the yield curve which tells you what really is going on. Just like the 2s, 10s, it's important. The spread between Germany and the US is also going to be a very good indicator about the state of the market. Throughout last week, it just could not move from this 115, 120 area. Really traded in a very narrow range, given what's been going on before. It basically now has found its level. If it starts moving back up, I think the market will regain some footing in terms of risk. But if it keeps on going down and down and down, and I think that is at the moment more likely, then you have a situation whereby the market is just not prepared to buy risk. And that's all that can be said about it. I think that these spreads are going to take a long time to base and move counter-cyclically in a sustained way, and therefore I think that risk is not likely to be persistent for quite some time. What to say about the dollar? I mean, it's getting very hard indeed. As I said last week, the dollar has the potential to become a huge wrecking ball here. It has the potential to absolutely destroy Asia and all the smaller markets, developing markets, simply because if supply chains get relocated towards North America, then there are less dollars in circulation in Asia and all the other developing markets, and that is going to produce a huge shortage of dollars and a huge move in their relative currencies. Really what we should now start looking at, and I will develop it over the next few weeks, is a dollar Asian currency basket, and see if my forecast of basically the supply chains moving and the effect on the Asian currencies comes to pass. I'm sure the central banks are very aware of the potential danger the dollar represents now to all their policies, and they will do their best to keep the dollar within a range. I don't think they will succeed. Eventually the dollar will start going up. Maybe not so much in the DXY, which is 60% in euros, and the rest all kinds of developed countries' currencies. But I think even the DXY will start moving higher. I think if we look at the on a daily basis, we're coming to an area where it's very interesting to start actually buying calls around this 97.87 level, and then finally around this 96.50 level. This 96.50 level, to me, it's always been a very good area to buy volatility, i.e. we either go up a lot or we go down a lot. We haven't managed to go down a lot. I think we will go up a lot. anywhere around this 96.50, 97.50 area, I think we will bottom out next week. It'll be a good area to pick up some dollars. Now onto our insurance policy. What a level 1458. It feels like only yesterday that we bought it, but in fact it's 2 weeks ago, and it just about managed to bottom tick the move. It's obvious that they had to sell gold because that was the only liquid thing they could sell. With the fall in the dollar, the gold went up. I don't think it's gonna start breaking the 1700 level at all. I think it's more likely to come back towards these moving averages here, 1530, 1560. But the fact that it's not breaking 1458 to me indicates that this is a trade that you want to be in for the long term. You want to have some insurance in the form of gold. It'll come off down towards the 1500s when the dollar is strong. It'll and bonds are strong, but it's when all is said and done, we are probably in a risk-off phase for quite some time, and there will be buyers of gold and old dips. To me, 1458 is still the Rubicon. Below that, it's quite bearish. Above it, it's quite bullish. So whenever it gets down there, if you're trading it, great. But if you are positioning, 1458 is a level that you really want to be positioned long. I almost don't look at the level of the S&P anymore. It's of no interest to me. I look at the level of volatility first and foremost, first thing in the morning. As I told you last week, these are the boundaries, 43 to 81. Just the fact that we came off a little bit of volatility, it led the market higher. It was obvious all last week volatility was falling, and therefore there would be a squeeze in the S&Ps at some stage. It happened, but the market, the volatility is actually leading the market back down, and did on Thursday and Friday. To me, it's obvious that we are in a holding pattern much like this. It's going to take some time for the market to digest this shock, and I would expect no quick return below the 43 level, and therefore I cannot be bullish beyond certain levels of the S&P. I'll show you in a moment how that analysis ties in with the levels in the S&P. But really, I'm not bothering to look at the S&Ps anymore because it's going to move percentage points away from certain levels very, very quickly, and therefore the level of volatility actually tells me in which area we should be trading in the S&Ps. Within 1 or 2%. What's that? 50 points. We move 50 points in 15 minutes. So this chart to me is far more important than the S&P chart, and it tells me that we are unlikely really to have substantial sustained rallies for quite some time. And together with VIX, this is the second chart I look at to give me an idea of what the market is doing. This is SPY against TLT. You want to look against comparative assets, i.e. an equity which is basically a perpetual bond, and TLT which is 20 years plus. So those are really as close together as can be made. Now, what is interesting about this chart is this. This is going back from 2002 when we were in a recession. So you see we were at 0.9 at the worst levels. Then we got the rally back up into 2007. We got to 183. And So whenever things were bad, really, really bad, and the market was really scared, we were basically between 140 and 0.92. And when things were relatively good, we were between 140 and 180. As you can see, this whole area here, this whole area here. And when things got really, really, really good, we went above 180, and this is the high. It just immaterial. But what's interesting is that this never made a new high with the S&Ps. It always stayed within a range, and then on the news it just collapsed and actually found support at the level that it's always found support, which is this 140 area. Okay, this is where it's found initial support. Now the question is, does it do one of these things and goes from from average to good? I doubt it. I doubt it. I think it's more likely that at some stage it breaks down to this level, and this is going to be historically the level to really, really get bullish of equities, because everybody will be bearish. 0.92. Now, we have another, what is it, 40% to go. Now, it's not 40% straight down in S&Ps. It could be down 30% in S&Ps and up 10% in TLT, things like that, combinations like that. But what I'm saying is that the market is really not discounting very much bearish stuff. Going into this area would not really, really surprise me. But I know now where my absolute level for risk is. This is the level that I want risk. And if you actually do a retracement, a Fibonacci retracement of these levels, you'll find that we are close to 0.618 retracement of this whole move up. And this area here, which is not really ridiculous to think that we will go to. You can see how much trading there was here, the 0.786 and the 762 is around 110, 115 area. I would really not be surprised to see us go down there. Great area to put on risk for the next 20, 30 years. I mean, this is 10 years worth of trading here. I would not be surprised to see that this is the low. This catches our low, because people will be so bearish. How do we put these spread charts and the volatility chart into context for what it means for the S&Ps? If we look at a monthly chart, really what it means is that over the course of the next 2-3 months, we have moves down towards the 50% at 2030, and possibly all the way down to 1708. That's what it is implying. If we then move to a daily chart, you will see why I thought that this 26-25 level was going to be very difficult to break, simply because it's the 0.382 retracement of the whole move down, and also you have all these moving averages, these very important moving averages just above it. And I always leave a little bit of a tip for the dealer. 26-25 caught it, within 10 ticks of the absolute high. What does it mean? It means that if we keep on finding tops around here, eventually the market will break lower. That's all I can say. We probably need several weeks of sideways action just to frustrate everyone. We achieved the 1.618 extension of the weekly move. We got there, we rallied where? We rallied straight back to 26-25 and this long-term weekly moving average. If we can't break above it, 3-4 weeks of trading, boom, we'll go down for one more leg, and we'll have probably the fifth wave down, which could be something like, a little bit shorter than this third wave. Does it really matter? I really don't believe in Elliott wave in terms of it has to be precise. But what it does make sense is that people give up and therefore slam it. If that is achieved, those levels around 2000 and 1750 that I just showed you are definitely not out of the question, and that would tie in with a revisit of volatility at 80 and that spread against TLT down in the generational buy zone. Now, how do we get to these levels in the S&Ps? Well, you'll agree with me that the only thing which is keeping the S&Ps up here is actually the tech component, the XLK component, which is the largest component. And that is by far the largest component in the Nasdaq. Well, if the Nasdaq were to fall to the bottom Bollinger Band on the monthlies around the 6,400 area, that would probably get us down, to the 2,000, 2,100 area in the S&Ps without any problem. And if we were to fall over the course of the next 3 months to say 5,400 to the 50% retracement, which, it would be no huge surprise, that would probably get us into the 1,750, 1,800 in the S&Ps. That is how we could do it. Is that a forecast? No, but it's all I'm saying is that if we see, if that is what we see, we should not be surprised. And we now have identified where we think the generational buying opportunity is. It's probably going to be when the Nasdaq is around 5,380, and that gives us an S&P level which is in the 1800s, and that spread that I showed you, S&P TLT down towards 1, that is going to be where you think this has got to be the end. Last chart I want to leave you with is a long-term monthly chart of the cash DAX. It got to 10,293 almost to the tick. And I did manage to get out of all the stuff that accumulated below, and I'm well out of just about all risk assets. I have so little on that I really don't care if it were to fall 10% overnight. To me, the next important level to look at, and I think it'll have bounces, vicious bounces from, is 8,100, 8,083. You give it a few ticks. I think there will be loads of stops there. It goes straight into you and then straight back up. So to me, we are going to be trading in the DAX for quite some time between this 10,300 area and this 8,000 area. If we fall through it for a couple of weeks, this market could get destroyed. I don't think there's going to be much support until we get to these kind of level, which is 5,300. That is a huge move. So to be on the safe side, what you do is you buy calls, which is exactly what what I did. I paid out for volatility, and what the hell. But I'm just showing you how dangerous this market is, because if it goes through there is absolutely, and I'll put in a level, there is absolutely nothing until this kind of area where the market traded a lot, and there's absolutely nothing below there until you get to these kind of lows, 5,300-ish. You can see how this area is going to be the next significant area of support if we start closing below 8,000. These are massive moves in percentage terms, absolutely massive. And that is, I'm showing you this because do not be surprised by having massive moves in terms of the S&Ps as well. Volatility is saying to me that I should not be surprised to see very, very large moves and to continue to see very large moves. And that is how that VIX chart, this DAX chart, and the SPY TLT charts come together. Do not be surprised by, moves which continue within a few days, give you 10-15%. It is normal with this kind of increased level of volatility to see that. Thank you very much indeed, and we have our levels and we will follow them, and I'll tweet you on Monday. Thank you very much indeed.